Here's the ultimate irony of crypto. We've built the smartest financial contracts in human history, but we're protecting them with the dumbest insurance policies ever written. While real-world asset tokenization is projected to hit $20 trillion within the decade, traditional insurance companies are still writing policies like it's 1995. And this massive blind spot is about to cost the entire industry billions of dollars. Picture this scenario. You're running a DeFi protocol, managing hundreds of millions in assets. Your smart contracts are audited, your security is military grade, and your tokenomics are perfect. Then disaster strikes, not from a hack or a bug, but from something completely unexpected. Your insurance company refuses to pay. This isn't hypothetical. It's happening right now across the crypto industry. Traditional insurance policies were designed for traditional finance. They have zero understanding of private keys, tokenized assets, stablecoins, or smart contracts. When crypto companies try to buy directors' and officers' insurance, the basic coverage every company needs, they get policies riddled with loopholes to allow denial of claims. Here's what's broken. Standard insurance policies exclude digital assets entirely. They don't cover intellectual property theft involving tokenized assets. They can't handle cyber attacks that target private keys. Most shocking of all, cyber insurance, supposedly designed for digital threats, rarely covers theft of digital assets or nation-state attacks. The result, companies taking transformative risks are completely exposed precisely when they need protection most. But wait, it gets worse. Regulation is supposed to bring clarity, but it's actually creating more insurance nightmares. Here's the twisted reality. Regulators today might be plaintiffs tomorrow. The Department of Justice just launched its civil rights fraud initiative, targeting companies that followed previous regulatory guidance. Banks that were encouraged to offer HUD-backed home loans in the 2000s later faced massive subprime litigation from the same agencies whose guidance they followed. Think about what this means for crypto. Companies following SEC guidance today could face billion-dollar lawsuits tomorrow if the regulatory winds shift. Standard insurance policies don't just fail to cover this risk, they actively exclude it. When administrative regimes change, litigation follows. And without proper insurance coverage, companies that played by the rules can still get financially destroyed. So what's the solution? According to insurance experts, it takes over 30 specific policy modifications to make traditional insurance work for crypto companies. These aren't minor tweaks. We're talking about completely rewriting policy definitions to cover confidential information, trade secrets, intellectual property, tokenized assets, cryptocurrencies, stablecoins, derivatives, private keys, and alternative units of value. Every single one of these terms is either undefined or explicitly excluded in standard policies. The modifications include eliminating common exclusions that gut coverage for digital asset companies, introducing affirmative digital asset coverage that actually protects what matters, and creating language that works regardless of regulatory changes or technology shifts. But here's the catch. Most companies don't know they need these modifications until it's too late. They buy off-the-shelf policies thinking they're protected, only to discover during a crisis that their coverage is worthless. The scale of this problem is staggering. Traditional finance enjoys billions in management liability insurance capacity. Digital asset companies? They're fighting over hundreds of millions. This isn't just about money, it's about the future of innovation. Companies can't attract high-quality boards of directors without functional insurance. Investors won't fund companies that could face operational and legal costs that should be covered by insurance. The insurance industry rewards certainty, so they've sat on the sidelines during the crypto revolution. Blockchain, DeFi, and tokenization risks remain hard to quantify, leaving insurers hesitant to dive in. But as disruptive technology evolves into mainstream technology, insurance capacity will expand, and costs will decline. The question is, how much innovation will we lose while waiting for insurance to catch up? Here's the bottom line. The crypto industry has solved the hardest problems in finance: trustless transactions, programmable money, and decentralized governance. But we're still vulnerable to the most basic problem in business: inadequate insurance. This isn't just a technical issue. It's an existential threat. Every crypto company operating without properly tailored insurance is one lawsuit, one regulatory change, or one cyber attack away from financial catastrophe. The smart contracts are getting smarter every day. The insurance needs to catch up, and fast. Because in an industry built on eliminating counterparty risk, the biggest counterparty risk of all might be your insurance company. If you're building in crypto, don't let dumb insurance kill your smart contracts. The future of decentralized finance depends on it.